January 8th, 2026. I was reviewing year-end institutional portfolio allocations when something stopped me cold. Vanguard, the second largest asset manager in the world with $8.1 trillion under management, had quietly moved $4.7 trillion into what can only be described as defensive positions over the past 18 months. Not gradual rebalancing, not seasonal adjustments, a systematic, coordinated shift away from growth assets into treasury bonds, gold, real estate, and cash equivalents that represented the largest institutional risk-off move in financial history. But here's what made this truly extraordinary. While Vanguard was building these defensive positions, BlackRock was still buying growth stocks, emerging market bonds, and technology assets as if everything was normal. The two largest money managers in the world were making completely opposite bets, with trillions of dollars at stake. My contact at a major pension fund put it perfectly. It's like watching two chess masters playing completely different games. Either Vanguard sees something BlackRock missed, or BlackRock knows something Vanguard doesn't. With $12+ trillion between them, one of these strategies is about to prove catastrophically wrong. The numbers were staggering. Vanguard had reduced equity exposure from 68% to 41% of total assets. They'd increased Treasury holdings by 340%. Gold and precious metals allocations had risen from 2% to 11%, the highest in the firm's history. This wasn't portfolio optimization. This was preparation for economic warfare. But what made this positioning truly ominous was that it aligned perfectly with a historical pattern that has repeated every time a reserve currency faced terminal decline. The debt mathematics, currency debasement, and institutional behavior all pointed to the same conclusion. We are entering the final phase of the dollar system's collapse cycle, the $4.7 trillion defensive signal. Vanguard's massive asset reallocation represents more than conservative portfolio management. It's a clear signal that sophisticated institutional analysis has identified systemic risks that mainstream financial media and most institutional investors are completely missing. The scale of the movement, $4.7 trillion, represents approximately 58% of Vanguard's total assets under management repositioned from growth-oriented investments to defensive positions over 18 months. To put this in perspective, that's more than the entire GDP of Japan being moved from offensive to defensive positioning. This isn't gradual asset allocation adjustment based on market cycles. This is emergency repositioning that suggests Vanguard's risk management models are showing probability scenarios that require immediate protection of client capital regardless of opportunity costs. The sophistication of the strategy. Vanguard's defensive positioning isn't simply moving money into treasury bonds and cash. It's a multi-layered strategy that includes short-duration treasury bonds that provide liquidity while minimizing interest rate risk. Physical gold holdings through specialized funds that provide inflation protection. Real estate investments focused on essential infrastructure that maintains value during currency debasement. Foreign government bonds from countries with stronger fiscal positions than the United States. Commodity-focused investments that benefit from supply chain disruption and currency weakness. The client protection imperative. Vanguard manages retirement funds, pension plans, and endowments for millions of Americans who depend on these investments for long-term financial security. Their defensive positioning suggests their actuarial analysis shows significant probability of market conditions that would devastate traditional growth portfolios. When institutions with fiduciary responsibility for retirement security take defensive positions, this extreme, they are essentially telling clients that preserving capital is more important than generating returns, a position that suggests they anticipate market conditions, where capital preservation becomes the primary challenge. The information asymmetry. Vanguard's positioning advantage likely comes from their access to institutional flow data, government bond auction results, and corporate treasury management decisions that provide early warning signals about developing systemic risks. As one of the largest participants in treasury auctions and corporate bond markets, Vanguard sees buying and selling patterns that reveal institutional sentiment before it shows up in public market prices or economic statistics. What BlackRock is missing? The debt mathematics crisis. While Vanguard has positioned defensively, BlackRock continues operating as if current economic conditions are sustainable long-term, suggesting they either don't recognize or don't believe the mathematical impossibility of current fiscal trajectories. The interest payment trajectory. U.S. federal interest payments reached $1.6 trillion in fiscal 2025, representing 32% of all federal tax receipts consumed simply servicing existing debt. Mathematical projections show this rising to 45% by 2028. And potentially 60% by 2030 if current borrowing trends continue. No country in recorded history has sustained debt service costs above 40% of tax revenues without either defaulting, implementing severe austerity that destroys economic growth, or inflating away the debt through currency debasement that devastates savers and creditors. The borrowing acceleration. Federal deficit spending has averaged $2.1 trillion annually since 2021, requiring the Treasury to issue approximately $170 billion in new debt monthly just to fund current operations and refinance maturing obligations. This borrowing pace is accelerating rather than stabilizing, with projected deficits exceeding $2.5 trillion annually by 2027-2028, as interest payments consume increasing portions of federal revenue, while social spending commitments continue growing. The buyer demand crisis. International demand for U.S. Treasury securities has declined dramatically, with foreign central banks reducing their Treasury holdings by $340 billion in 2025, while domestic institutional buying has slowed significantly. The Federal Reserve has been forced to purchase increasing quantities of Treasury issuance to maintain stable interest rates, effectively monetizing federal debt through money creation that devalues the currency and creates inflationary pressures throughout the economy. The currency debasement inevitability. With debt service costs consuming ever larger portions of federal revenue, the government faces impossible choices: raise taxes to unsustainable levels, cut spending dramatically, or debase the currency through money printing that reduces the real value of debt obligations. Political reality makes tax increases or spending cuts unlikely on the scale required, leaving currency debasement as the most probable outcome, a scenario that devastates holders of dollar-denominated financial assets, while rewarding holders of real assets and foreign currencies. The historical collapse pattern Vanguard recognizes. Vanguard's defensive positioning aligns perfectly with historical patterns that occur when reserve currencies enter terminal decline phases due to unsustainable debt accumulation and currency debasement pressures. The Spanish silver debasement, 1550-1650, Spain's control of American silver mines provided enormous wealth that financed European wars and imperial expansion. But instead of investing silver wealth in productive capacity, Spain used it to fund consumption and military campaigns that generated no economic returns. When silver production declined and military costs continued rising, Spain began debasing silver coins by reducing silver content while maintaining face value. This currency manipulation temporarily masked fiscal problems while destroying confidence in Spanish currency that had been accepted globally. The result was rapid loss of Spanish monetary dominance as merchants worldwide refused debased Spanish coins, forcing Spain into bankruptcy and permanent imperial decline within a century of controlling the world's primary monetary metal. The British pound sterling crisis, 1914-1971. Britain financed 2 world wars through debt accumulation and currency creation that transformed the pound from gold-backed currency to paper money backed only by government promises. After 1945, Britain attempted to maintain pound dominance through political arrangements and imperial preference systems. But underlying fiscal weakness made this unsustainable. The 1967 pound devaluation revealed that sterling's international status had become artificial. By 1971, even the Bretton Woods system couldn't maintain pound convertibility, forcing Britain to abandon any pretense of monetary leadership as the dollar assumed complete dominance in international commerce and reserves. The Roman denarius debasement, 200-400 AD. Rome's expansion was initially financed through conquest that brought more wealth than military campaigns cost. But by 200 AD, military expenses exceeded conquest revenues while domestic productivity declined due to slave labor displacing innovation. Roman emperors began reducing silver content in denarii from 95% to eventually less than 5%, while maintaining official values through legal tender laws. This currency manipulation temporarily funded military expenses while destroying economic productivity and trade relationships. The denarius collapse triggered economic fragmentation throughout the Roman Empire, as regions reverted to barter systems, or local currencies, contributing directly to political fragmentation and imperial collapse. The pattern recognition. In each historical case, reserve currency collapse followed identical patterns. Initial wealth and power based on genuine economic or military advantages, transition to debt-financed consumption and expansion beyond productive capacity. Currency manipulation and debasement to fund unsustainable spending commitments. Loss of international confidence and gradual abandonment by trading partners. Rapid economic and political decline as monetary privilege disappears. The United States has clearly entered stages 3 or 4 of this pattern, with currency debasement accelerating, while international confidence in dollar dominance erodes measurably. Corporate money flight. The smart money warning. Beyond Vanguard's institutional positioning, corporate treasury departments are making similar defensive moves that suggest sophisticated financial analysis has identified systemic risks, requiring immediate protection strategies. Corporate cash holdings. Surge. S&P 500 companies are holding $3.7 trillion in cash. and cash equivalents as of December 2025, representing a 47% increase from 2023 levels, despite historically low interest rates that make cash holdings expensive. This cash accumulation suggests corporate treasury departments are prioritizing liquidity and capital preservation over growth investments or shareholder returns, behavior that typically occurs when CFOs anticipate economic disruption that makes cash more valuable than business expansion. Foreign currency diversification. Multinational corporations are systematically diversifying cash holdings away from dollar concentration, with many companies increasing euro, yen, and even yuan cash positions to reduce exposure to potential dollar devaluation. This currency diversification by American corporations represents a vote of no confidence in long-term dollar stability by the financial professionals most responsible for protecting corporate assets and maintaining operational flexibility. Supply chain inventory build. Companies are building inventory levels 23% above historical norms, despite carrying costs, suggesting preparation for supply chain disruptions or currency instability that could make future procurement more expensive or difficult. The inventory build represents billions in capital tied up in physical goods rather than financial investments, indicating corporate expectations that physical assets will outperform financial assets during coming economic turbulence. Capital expenditure. Postponement. Despite record corporate profits, capital expenditure growth has slowed dramatically as companies delay major investments until economic uncertainty resolves. Behavior consistent with expecting significant market disruption within 12-24 months. The CapEx delay suggests corporate strategists believe current economic conditions are unsustainable, and major changes are coming that could make current investment decisions inappropriate for future operating environments. The Federal Reserve's impossible position. Vanguard's defensive positioning reflects understanding that the Federal Reserve faces impossible policy choices where every available option creates serious economic problems that could trigger the systemic risks institutional investors are preparing for. The interest rate dilemma. Raising interest rates to combat inflation increases federal debt service costs that already consume 32% of tax receipts, potentially forcing fiscal crisis. But keeping rates low allows inflation to accelerate, devastating savers and creditors while creating social instability. Current federal debt levels make traditional monetary policy ineffective because rate increases threaten government solvency while rate decreases fuel inflationary pressures that destroy economic stability. The balance sheet trap. The Federal Reserve. His balance sheet has expanded from $4.2 trillion in 2020 to $8.9 trillion in 2025, representing unprecedented money creation that has distorted asset prices throughout the economy. Reducing the balance sheet, quantitative tightening, would crash asset prices and trigger deflationary recession, while maintaining current levels continues inflating asset bubbles that make eventual correction more devastating. The currency debasement pressure. International dollar demand is declining as foreign governments reduce treasury holdings and develop alternative payment systems, forcing the Federal Reserve to choose between defending dollar value or accommodating fiscal needs. Defending the dollar requires high interest rates that crash the domestic economy, while accommodating fiscal needs requires money printing that accelerates international dollar abandonment. The systemic risk reality. Every Federal Reserve policy option creates systemic risks that could trigger the financial crisis that Vanguard and sophisticated corporate treasuries are positioning to survive. This policy impossibility suggests that systemic crisis isn't a risk to be managed. It is an inevitable outcome of mathematical relationships that have developed beyond the point where policy solutions exist. The timeline. When defensive positioning pays off. Based on historical patterns, debt mathematics, and institutional positioning, here's how the developing crisis will likely unfold and reward defensive positioning strategies. Phase 1. Recognition acceleration. Q1, Q2, 2026. More institutional investors recognize the signals that Vanguard identified early, creating broader movement toward defensive positioning that validates Vanguard as strategy while potentially triggering the crisis they are preparing for. As defensive positioning becomes widespread, asset prices in traditional growth investments face selling pressure, while defensive assets experience increased demand that drives prices higher. Phase 2. Policy response failure. Q2, Q4, 2026. Federal Reserve attempts to address developing crisis through traditional policy tools prove ineffective due to mathematical constraints, creating market recognition that policy solutions are inadequate for current problems. This phase features increased volatility and breakdown of correlations between asset classes as markets realize that normal relationships no longer apply in current economic environment. Phase 3, system stress testing, Q4, 2026, Q2, 2027. Market events test the resilience of financial institutions, payment systems, and government finances. revealing vulnerabilities that have developed during the era of low interest rates and deficit spending. Defensive positioning becomes essential during this phase as traditional diversification strategies fail, while physical assets and government securities from fiscally sound countries provide protection. Phase 4, structural transition, Q2 2027-2028. Economic and financial systems adapt to new reality where fiscal constraints and international dollar skepticism require fundamental changes to government spending, monetary policy, and international trade relationships. Defensive positioning pays off maximally during this phase, as preserved capital can be deployed advantageously when crisis creates opportunities for those with liquidity and flexibility. Positioning for the Vanguard scenario. Understanding Vanguard as defensive strategy provides a roadmap for individual investors and institutions that recognize similar systemic risks and want to position accordingly. Asset allocation rebalancing. Following Vanguard, this model suggests reducing equity exposure from typical 60-70% to 40-45%, while increasing Treasury bond holdings, precious metals allocation, and real estate investment trust positions. This rebalancing sacrifices potential upside during continued market expansion while providing protection during the systemic stress that sophisticated institutional analysis suggests is developing. Geographic diversification. Vanguard. The strategy includes significant international diversification focused on countries with stronger fiscal positions and less exposure to dollar system problems. This geographic diversification provides currency hedging and exposure to economies that may benefit from dollar system instability rather than suffering from American fiscal problems. Liquidity maintenance. Defensive positioning requires maintaining higher cash positions and shorter duration investments that provide flexibility during uncertain periods when traditional investment assumptions may prove incorrect. Liquidity becomes particularly valuable during crisis periods when opportunities emerge for those with capital to deploy, while others face forced selling due to leverage or liquidity constraints.